Imagine trying to find out why your bank account was suddenly drained, and the bank just, hands you a 500-page legal document, points to a clause in like 4-point font, and just shrugs.
Oh, yeah, just the absolute worst-case scenario.
Right, and for decades, consumer financial grievances were essentially a black hole. I mean, you'd file a complaint, and it would just get passed around this labyrinth of regional offices and branch managers and obscure departments.
Utterly exhausting.
Exactly. And you, the consumer, were just left completely in the dark. It was less like customer service and more like uh, a war of attrition.
It absolutely was. And the burden was entirely on the consumer. I mean, financial services aren't just mechanical one-off transactions, right?
Not at all.
They involve massive institutional hierarchies, deeply opaque technological platforms, and complex legal agreements that the average person simply doesn't have the time or the expertise, really, to decode.
Right. You're not a lawyer.
Exactly. So finding exactly where the service broke down and getting someone to actually take responsibility for it used to be a profoundly exhausting, highly localized exercise.
Which perfectly brings us to today's deep dive. Welcome, everyone. If you have ever felt entirely helpless on hold with a bank, or if you are tracking how consumer protection has evolved from a reactive afterthought into a massive, heavily funded, proactive regulatory shield, well, you are in the right place.
You really are.
Today, we are taking a magnifying glass to the Reserve Bank of India, specifically diving into Chapter 20 of their working documents on consumer education and protection. And our mission today is highly specific.
Yes, it is. We are essentially acting as your personal academic researchers and instructional designers.
Exactly. We are going to build the ultimate, highly detailed audio blueprint and basically a mental text-based infographic for this chapter. You are prepping to master this material, and by the end of this deep dive, you honestly won't even need to reread the chapter.
That's the goal. Because consumer protection in the financial sector isn't just about reading the fine print anymore. It's an evolving, highly sophisticated battlefield.
It really is.
And the RBI has systematically built this massive shield to protect everyday people. What we are going to look at today is a complete structural dismantling of this chapter into 7 distinct exam-ready sections. We're talking a complete paradigm shift from a fragmented jurisdiction-based system to a centralized, tech-driven framework.
So let's jump right into Section 1 of our blueprint. The core concept and title. If we are proposing a title for our mental infographic here, I'm thinking something like the RBI Shield, Customer Centricity, and the Integrated Grievance Redressal Architecture.
I like that. It covers all the bases.
Okay, so give me the tight 2-sentence academic summary that goes right under that title.
All right, here's the summary. Chapter 20 details the Reserve Bank of India's comprehensive mandate to safeguard consumers and ensure financial stability through stringent regulatory interventions, unified ombudsman schemes, and targeted financial education.
Okay, that's sentence 1.
In sentence 2, it highlights the paradigm shift from fragmented, jurisdiction-based grievance redressal to a centralized, tech-driven, one nation, one ombudsman framework that empowers the consumer.
Customer centricity. It sounds almost like a buzzword a tech startup would use in a pitch deck.
It does, yeah.
But when a central bank adopts it, it carries a ton of regulatory weight. I mean, why does the Reserve Bank of India, an institution tasked with macroeconomic stability, inflation, monetary policy, why do they care so deeply about whether you, an individual consumer, gets a refund for a failed ATM transaction?
It's a great question, and the answer is surprisingly psychological. The text explicitly draws on international frameworks, specifically from the World Bank and the OECD and G20, to explain this connection.
Right, the global perspective.
Exactly. The World Bank notes that customer centricity involves suitability, choice, safety, fairness, voice, and purpose. But why does a macroeconomic regulator care about your voice? Because a lack of trust leads directly to systemic failure.
Wait, let me stop you there. Connect those 2 dots for me. How does one rejected complaint lead to systemic failure?
Well, think about what a bank actually is. A bank does not hold all of its depositors' money in a giant vault.
Right, they lend it out.
They lend it out. The
Right.
entire system operates on a shared psychological fiction. It's the belief, the trust, that if you ask for your money back, the bank will give it to you.
Ah, I see where this is going.
Right. And the RBI is statutorily mandated by the Banking Regulation Act of 1949 and the RBI Act of 1934 to operate in the interest of depositors. If consumers feel they are being tricked by hidden fees or their legitimate grievances vanish into that black hole we talked about, they
Yep.
don't just get angry.
They withdraw their participation.
Exactly. They pull their money out of the formal financial system, they stuff it under a mattress, or put it into unregulated shadow economies.
And if enough people do that, if public trust just evaporates, you get bank runs, you get a liquidity crisis.
You get complete macroeconomic instability. The stability of the entire financial ecosystem rests entirely on public trust. So the RBI elevates consumer protection to the exact same level as financial stability. They're completely interdependent.
That makes perfect sense. The protection of the consumer is literally the protection of the system itself. So if we understand that philosophy, let's move to section 2 of our infographic, the timeline and chronology.
Let's map it out.
Because to really appreciate this modern shield, we have to look back. And looking at the notes here, it looks like the 90s opened the door, but the late 2010s were just a massive tech-driven sprint. It's like going from dial-up internet to fiber optics. Map out these historical sequences for us.
Okay, if you're taking notes, we start with what we call the committee era, stretching from 1975 to roughly 2010. The RBI relied heavily on forming expert committees to evaluate the landscape.
Who are the key players in this era?
We have foundational changes driven by a sequence of committees. The Talwar Committee in 1975, Goiporia in 1990, Nassimham in 1991, Terrapur in 2003, and Dima Daran in 2010.
That 1991 Narasimham Committee is a huge one, right? That's the year of massive economic liberalization in India.
It was the turning point. That committee stimulated competition through deregulation and allowing private sector entry. Suddenly, the old nationalized banks had to compete for depositors.
And with competition comes the necessity for better customer service.
Precisely. Now, fast forward to 1995. Put a huge scar next to this date. 1995 is when the very first banking ombudsman scheme, the BOS, is introduced.
The first time there's a formal referee on the field.
Exactly. But it was still regional, heavily decentralized. So the next big date is July 1st, 2006. That is when centralization begins with the creation of the Customer Service Department, the CSD, at the RBI.
Okay, so 2006, they pull things under one roof internally. What's the next major milestone?
We move to the 2014-2015 window. Two big things happen. The CSD is rechristened as the Consumer Education and Protection Department, the CEPD, in November 2014.
Oh, wow. So they changed customer service to consumer education and protection. That's a very deliberate shift in tone.
Highly deliberate. And during this time, they formulate the Charter of Customer Rights. Then, in 2015 and 2016, they establish Consumer Education and Protection Cells, or CEP cells, in all RBI regional offices.
Basically a secondary safety net for things that didn't fit the ombudsman criteria.
Right. But then we hit that fiber optic sprint you mentioned, the smartphone era.
The late 2010s, what happens?
Rapid fire. February 23, 2018. Launch of the Ombudsman Scheme for Non-Banking Financial Companies, or NBFCs, and in that same year, the Internal Ombudsman, or IO mechanism for banks, is institutionalized.
So 2018 brings in the NBFCs and the internal policing.
Yes. And note that on April 26, 2019, they extended the NBFC scheme to non-deposit taking NBFCs too. Then, January 31st, 2019, the launch of the Ombudsman Scheme for Digital Transactions, the OSDT.
Because digital payments were just exploding.
Exactly. And to manage all this, on June 24, 2019, they launched the Web-Enabled Complaint Management System, the CMS.
Okay, but as we'll see later, having 3 separate ombudsman schemes was a bit of a jurisdictional nightmare. So that brings us to the masterstroke.
November 12, 2021, the Prime Minister launches the Reserve Bank Integrated Ombudsman Scheme, 2021. The RBIOS.
The One Nation, One Ombudsman approach. Huge date.
Massive. And they didn't stop there. March 2022, the Committee for Review of Customer Service Standards is set up under Sri BP Kanungo. September 1, 2022, RBIOS is expanded to include credit information companies, the CICs.
The credit bureaus get pulled in.
Right. Then 2023, harmonized internal ombudsman directions are issued. And finally, jumping to March 2024, the launch of the third awareness booklet, the Alert Family, and the introduction of audio CAPTCHA in the CMS for the visually impaired.
Okay, that timeline is packed, and it is filled with acronyms and technical jargon. So let's move to section 3, key terminology and definitions. I am going to act as the student checking their flashcards here. I want you to bold the exact phrasing from the text for our listeners.
Ready when you are.
Let's start with the big philosophy. Define customer centricity.
Customer centricity, providing solutions based on an understanding of customers' needs, preferences, and behaviors, encompassing suitability, choice, safety, fairness, voice, and purpose.
Next flashcard. The big 2021 scheme. Define RBIOS.
Reserve Bank Integrated Ombudsman Scheme 2021, RBIOS, a scheme that integrated three previous ombudsman frameworks into a single, simplified grievance redress process based on a one nation, one ombudsman approach.
Now, this next one is crucial. Under the new scheme, how exactly do they define a complaint?
Complaint, defined under RBIOS simply as a deficiency in service, which replaced the previous approach of listing specific, defined grounds for complaints.
That's such a massive shift, just deficiency in service. Okay, next turn. Where do these complaints go? Define CRPC.
Centralized Receipt and Processing Center, CRPC, a facility set up at RBI, Kennegar, responsible for the initial receipt, digitalization, and processing of all physical and email complaints under RBIOS.
Okay, now here's a term that fascinates me. Define internal ombudsman. Because what stands out to me here is that it sounds almost like an internal affairs division for a police department. Why do the banks need to police themselves first?
I'll define it first, then explain. Internal Ombudsman, IO, an independent apex-level authority within a regulated entity tasked with reviewing partially or wholly rejected customer complaints before the entity's final decision is conveyed to the complainant.
So they literally intercept rejections.
Exactly. It forces institutions to build an independent review board inside their own walls so the RBI doesn't become the world's biggest customer service call center.
Makes sense. Okay, next term, the tech backbone, CMS.
Complaint Management System,
Yeah.
CMS. A web-enabled IT platform launched by the RBI to manage complaints efficiently, provide robust management information systems, MIS, and facilitate data analytics.
Next up, the safety net we mentioned earlier, CEP cells.
Consumer Education and Protection Cells, CEP cells. Units established in RDI regional offices to handle grievances not covered under the Ombudsman scheme, or involving entities not covered by the scheme.
Let's define the rights themselves. Charter of Customer Rights.
Charter of Customer Rights. Overarching principles of consumer protection comprising 5 rights. Right to fair treatment, right to transparency, fair and honest dealings, right to suitability, right to privacy, and right to grievance redress and compensation.
And finally, on the education side, NIAP.
Nationwide Intensive Awareness Program, NIAP, a month-long awareness event in November 2022 utilizing innovative strategies like Nakad-Nataks, which are street plays, flash mobs, and interactive voice response systems.
With that terminology locked into our blueprint, let's transition to Section 4, Important Figures and Names. Who are the architects, the people and institutions that actually built this vocabulary?
Well, starting with the recent developments, you definitely need to know Sri BP Kanungo.
Right, the former deputy governor.
Yes, former deputy governor of RBI, who chaired the 2022 Committee for Review of Customer Service Standards in RBI-regulated entities.
And what about the historical architects?
You'll want to list the historical committee chairs: Talwar, Goiporia, Narasimham, Terpur, and Damodaran. And for your exam notes, specifically remember that the Narasimham Committee is noted for stimulating competition through deregulation and private sector entry.
Got it. And on the global scale?
The World Bank and OECD G20, these are the international organizations whose frameworks and 12 principles heavily influence the RBI's approach to customer centricity.
Okay, now what about specific roles created within the framework?
2 big ones to note. First, the Deputy Ombudsman. This is a new level of approving authority introduced under RBIOS, granted powers to approve the closure of certain non-maintainable complaints and those resolved through facilitation.
So they help clear the backlog.
Exactly. And second, the Deputy Internal Ombudsman, a newly introduced role within the 2023 Harmonized I/O directions to assist the internal ombudsman inside the banks.
Perfect. So we have the timeline, the vocab, the architects. But you and I know that institutions run on hard data.
Oh, absolutely.
So let's jump into Section 5, vital statistics and empirical data. Because to truly prepare you, the listener, we need to extract every critical number and metric from the chapter. Isolated, high-impact bullet points for memorization.
Let's do the numbers.
Starting with the physical footprint.
32. That is the number of consumer education and protection cells currently working across RBI offices.
Now let's talk about the regulatory thresholds. Because they don't oversee every tiny entity. What's the number for NBFCs?
100 crore, the minimum asset size threshold for non-deposit-taking NBFCs to be included in the 2019 extension of the NBFC Ombudsman Scheme.
And for the cooperative banks?
50 crore. That is the minimum deposit size from the previous financial year's audited balance sheet for non-scheduled primary urban cooperative banks to fall under the RBIOS jurisdiction.
Now, what about the mandate to actually hire that internal ombudsman we talked about?
10 or more. That's the number of banking outlets or branches required for a bank or deposit-taking NBFC to be mandated to appoint an internal ombudsman.
What if it's a non-deposit-taking NBFC?
5,000 crore. The asset size threshold for non-deposit-taking NBFCs with public customer interface to require an IO.
And the digital wallets, the tech players?
1 crore. That's the outstanding prepaid payment instruments, or PPIs, threshold for non-bank system participants to require an internal ombudsman.
Let's shift to the consumer access numbers. If I need help, what are the numbers?
14440. The phone number for members of the public to give a missed call to access the interactive voice response system regarding fake offers and safe investing.
And for active complaints?
14448. The contact center number at the CRPC in Chandigarh.
How many languages does that center support?
10. The number of regional languages plus Hindi and English, supported by the CRPC contact center.
Okay, now for the audit data. The self-evaluation the RBI did.
This is massive. 1 lakh plus bin, so over 100,000. That is the number of outbound calls made during the telephonic consumer satisfaction survey.
Over 100,000 outbound calls just to ask, how did we do? That shows an intense level of self-auditing.
Truly. And from that, 35,683. That is the number of complete actionable responses gathered in the survey.
And the results? Hit us with the percentages.
60.1%. The percentage of respondents satisfied with the overall process under RBIOS, meaning registration, handling, and resolution time.
What about the resolution itself?
60%. Roughly 60% were satisfied with the overall resolution provided by Reserve Bank Ombudsman.
And wait times?
58.7%. The percentage of respondents who found the waiting time or attempts to reach a contact center executive reasonable.
You know, these statistics, they aren't just trivia. To get a 60% satisfaction rate from highly distressed consumers who might have just lost money is actually incredibly robust.
It really is. And these numbers are the result of very deliberate policy choices, which leads us perfectly into Section 6, cause and effect relationships.
Yes, Section 6. We have the data, but I want to challenge you to explain the why behind the actions. What triggered these massive systemic overhauls? Let's map out the arguments. First cause.
Cause. Fragmented jurisdiction-based ombudsman schemes with narrow, specific grounds for complaints created massive confusion and inefficiency for consumers.
So what was the effect?
Effect. RBI integrated the schemes into the RBIOS 2021, the One Nation, One Ombudsman approach, and redefine the basis of a complaint to a broad deficiency in service.
And the result of that?
Result, a streamlined, centralized process via the CRPC in Chandigarh and the CMS platform, making it vastly easier for consumers to seek redress.
Brilliant. Next cause. We mentioned the RBI getting overwhelmed earlier.
Right. Cause. A high volume of customer complaints was escalating straight to the regulator, overwhelming the RBI's external ombudsman system.
The effect.
Effect. The RBI mandated the internal ombudsman mechanism across banks, NBFCs, and CICs.
And the result of forcing them to have internal affairs?
Result. Complaints are independently reviewed and potentially resolved inside the financial institution before ever reaching the RBI, reducing external load and improving internal accountability.
Okay, third cause. Let's look at the digital side.
Cause. The exponential rise in digital transactions led to a parallel rise in complex, tech-enabled financial frauds.
So what did they do? What was the effect?
Effect. The RBI launched the Ombudsman Scheme for Digital Transactions in 2019, followed by multi-pronged awareness campaigns. Things like Be Aware, Raju and the 40 Thieves, the Alert Family booklets, and those RBSay SMS alerts.
And the result of all that education?
Result. Consumers are preemptively educated against unsolicited dubious offers, shifting the focus from purely reactive grievance redressal to proactive consumer protection.
Love that. Okay, final cause and effect. And this is my favorite one because it involves financial penalties.
Ah, yes, cause. A need to force banks to improve their first-line customer service and internal grievance mechanisms.
The effect.
Effect. The RBI instituted a disincentive incentive framework.
And what exactly is the result of that framework?
Result. Banks with a volume of maintainable complaints higher than their peer group average are forced to bear the financial cost of the redressal process. It creates a direct financial incentive to fix customer service issues early, at the branch level.
Because if they don't, the RBI literally bills them for the regulatory time it takes to fix their mistakes.
Exactly. Hit them in the bottom line.
It is brilliant regulatory design. So to really cement this knowledge for you, the listener, we need to view these shifts side by side.
We need a matrix.
Exactly. Let's move to Section 7, the comparative matrix. We are going to verbally construct a markdown-style table contrasting the old fragmented system with the new integrated RBIO system. Let's run through the categories.
Okay, Category 1, System architecture.
What was the pre-2021 framework?
3 separate schemes. Banking in 2006, MBFCs in 2018, and digital transactions in 2019.
And the post-2021 RBIOs?
1 single integrated ombudsman scheme.
Nice. Category 2, jurisdiction and routing.
Pre-2021 was territorial or regional jurisdiction. Complaints were routed to geographically specific offices.
Post-2021.
One nation, one ombudsman approach. All physical and email complaints are routed centrally to the CRPC in Chandigarh.
Okay, category 3, definition of a complaint.
Under the old framework, it required matching the grievance to a rigid list of specific defined grounds.
And the new standard.
Broadly defined simply as a deficiency in service, with a very small, limited list of exclusions.
Massive upgrade. Category 4, institutional coverage.
The pre-2021 older framework covered commercial banks, select NBFCs, and non-bank system participants.
What got added post-2021?
It expanded to include non-scheduled primary urban cooperative banks with deposits over 50 crore and credit information companies, the CICs.
And finally, category 5, complaint tracking technology.
The older system used the Complaint Tracking System, or CTS,
And the modern system.
a modern complaint management system, or CMS, featuring end-to-end digitization, MIS data analytics, and accessibility features like audio captcha.
And there it is, the complete, exhaustive blueprint of Chapter 20. Congratulations, if you have tracked with us this far, you are now armed with the definitive architecture of the RBI's Consumer Protection Shield.
You really are.
Yeah.
And honestly, studying this breakdown makes rereading that dense chapter completely unnecessary.
Absolutely. But before we wrap up this deep dive, we always like to leave you with a final provocative thought, something to mull over on your own that builds on this material.
And here's that thought. We spent this time dissecting how the RBI built this centralized, tech-driven grievance system to hold human institutions accountable. But as we move rapidly toward a future where artificial intelligence handles Tier 1 customer service, where chatbots handle your initial dispute, or where automated algorithms make instant loan approvals, how will the RBI standard of deficiency in service adapt?
Wow, yeah.
When a machine learning model makes a biased, discriminatory error against a consumer, who exactly is the internal ombudsman reviewing? Are they auditing the human institution, or are they auditing the algorithm?
How do you take an X-ray of a neural network?
Ex-
That is a deeply fascinating question, and one the regulators will have to answer very soon. We strongly encourage you to keep this mental infographic handy. Thank you for joining us, and best of luck applying this deep knowledge in your exams and professional pursuits. Keep diving deep.